everyone, my name is 𝗂𝗺𝗃𝗃. I'm a senior analyst within 𝗬𝗺 consulting division in London, and welcome along to the latest instalment of the 𝗬𝗺 Fertilizer mini-series, where today we'll be taking a deep dive into the current dynamics of the urea market and exploring expectations for the near-term outlook. So urea supply remains under considerable stress. We have not seen this level of disruption to global export availability at any point in history, and as a result, prices across several origins have risen sharply by 50, 60 and excess of 70% in some cases. So the steepest increase that we've been seeing so far in the Middle East, but also in those import dependent markets where demand is strong or is trending more strongly. So I think Australia is a pretty good example of this, where prices are up by around 72% on pre-conflict levels as buyers enter peak season. So Australia is one of those markets with strong GDP, strong purchasing power, and generally speaking, buyers have been able to absorb higher prices. But of course, there are several markets that have shown considerably more hesitation at these kind of levels, those with considerably weaker purchasing power than the developed economies. So the primary driver behind the price rally that we've seen, of course, is the scale of disruption to urea exports out of the Middle East Gulf. This is a region which accounted for roughly a third of globally traded urea supply in 2025, and of this volume, most of this supply sits beyond the Strait of Hormuz or loads directly from Iran. Now, it's quite difficult to separate what has been lost so far. Some urea has been lost as a result of production losses, but that is slightly different to the loss of export availability. Several producers on the Arabian Gulf have been able to continue to produce and are utilising on-site or floating storage as a means of doing so, but of course some have shut down. And so when combining Arabian Gulf losses and those in Iran as well, we come to a figure just in excess of 1.5 million tonnes of urea so far. Now, the impact has also been pretty severe in South Asia. This is a region that is feeling the indirect effects of the conflict. And we estimate that close to 1 million tonnes of urea has been lost in India so far, and further losses are also projected in Pakistan and in Bangladesh as well. Now, these countries in South Asia, they have limited domestic gas capacity, and they have high reliance on importing and regasifying LNG from the Middle East Gulf, so mainly Qatar, but also the UAE as well. And so as a result of the conflict in the Middle East, it is exposed just how fragile the gas balances of these South Asian economies have become in recent years. Taking India as a case study, around 85% of the gas that was consumed within the country's urea sector last year came from imported LNG, much of it Middle Eastern and most of it from Qatar. Now, LNG imports this year and in March and April have started to tail off. In April, we're tracking considerably behind the 5-year averages, which raises serious questions about India's ability to secure its import requirement for urea this year. Of course, it's important to stress that we don't have full April data, but we can see in that yellow line that the March total is already trending below each of the last 5 years. So I guess the question is, with supply disrupted out of India and Middle Eastern urea, at least at the moment, most of it being off the table, can India and the wider market find credible alternatives to Middle Eastern urea supply? The short answer is no. I think outside of China, there are a few producers that have the capacity or the flexibility to increase operating rates and then by extension exports meaningfully in 2026. I think most producers are operating close to or at full capacity, and some face their own gas issues, operational constraints, pricing problems. So the market is structurally incredibly tight, and at the moment we're effectively operating in two scenarios, one with Chinese exports in the market and one without. So as a result, India and the wider import market globally are just so heavily reliant on a return of Chinese exports as quickly as possible. When it comes to our modelling, our base case assumes that exports resume around May, This follows the closure of the domestic fertilizer season in China, and we would expect China to do more business this year. Producers are facing, at least coal-based producers, are seeing the lowest coal costs in 4.5 years, and the margins are as good as they have been in history, to be honest with you. So higher exports supported by strong margins, but also strong capacity growth, and providing that plant utilisation remains high and demand growth year on year is relatively modest, then the capacity to do more business is absolutely there. But of course, risks do remain. So China has taken an increasingly protectionist stance on urea availability, fertiliser self-security in recent years in a bid to prioritise its domestic market and effectively shield consumers from global price volatility. So this is something that could certainly add some downside risk to the export view. So a lot of players are hugely reliant on China, but China remains a huge wildcard to market fundamentals. Just finally, a comment on the level of plant outages that we've seen since this disruption started. If I draw your attention to the graph in the bottom right of the slide, we've recorded around 20 new outages in March alone. So this is obviously coinciding with the escalation of conflict in the Middle East, and if you look back through historical levels, while we're not showing Egyptian production losses here, the scale of loss that we're seeing is quite unprecedented, and that sharp peak towards 20 losses really just highlights how the desperate position that the market is in at the moment. So which import markets are most exposed as we move further through the second quarter? What I'm showing on the left hand side are those key urea buying windows for the major import markets. Now, while most markets west of Suez are now starting to move out of season, think about Europe and the US, I think the greatest risk is sitting in the southern hemisphere at the moment as winter crop field work begins. So Australia stands out again as a good example. Nitrogen availability, as I mentioned before, is tight, prices are high, and this is likely to push growers to reduce wheat area in favour of crops like canola and barley. So these are crops that require slightly less tons of nitrogen to grow. With El Niño looking increasingly likely later in the year, it's likely that crop conditions are going to shape up to be particularly challenging for Australian growers this year. In Southeast Asia, there are markets here heading into season imminently, so Thai importers have so far been able to sit on the sidelines. The government has been citing that stock levels are pretty healthy, but of course importers will need to return to the market in May as demand increases and inventories begin to decline. Now, I touched on India earlier, given their crucial importance in the global market. I think stocks were relatively comfortable in March and into the very start of April, but of course attention is quickly shifting to the Kharif planting season, which gets underway from June. So import demand will almost certainly need to accelerate pretty quickly. I think that explains India's most recent tender to purchase 2.5 million tonnes of urea. And to be honest, I think it would be reasonable to assume another tender before that season begins. Turning to the outlook for the conflict on the right-hand side, now of course so much uncertainty really remains. This is something that we put together earlier in April to try and quantify just how quickly the market could return to a new normal and how quickly that Middle Eastern urea exports could return to the market. So as we're all aware, there is currently a fragile ceasefire between the US, Israel and Iran. Negotiations are ongoing, and I'm quite cautious of becoming rolling news here, but a lasting peace agreement, at least at the moment, at the time of speaking, doesn't appear imminent. So the supply recovery scenario on the right hand side is probably more optimistic than not, if I'm honest, and I think in all likelihood we could see the level of disruption that we've seen like through April, as we show here, potentially persisting into May, and that recovery just being pushed a little bit later down the line. But of course, once the Strait of Hormuz does reopen, then I think it will be pretty easy to get urea flowing pretty quickly. So urea as a bulk commodity, it doesn't require specific handling characteristics like shipments of ammonia or LNG would. And also it's worth bearing in mind again that there's about 1 million tonnes of urea that's already sitting in the Arabian Gulf that's ready to ship. So in an ideal world, I think this could flow quite quickly. That being said, I think disruption is likely to persist for some time. Of course, that backlog of 1 million tonnes must clear first before additional business can take place, and the majority of that 1 million tonnes is secured under long-term offtake agreements or under Indian tenders, for example. And then also on the cost side, I think shipping costs, insurance premiums are almost certainly to remain elevated, and it will also take time to fully restore confidence, shippers' confidence that transit through the Strait of Hormuz is fully safe. And so I think as a result, like I said before, I think this recovery scenario may likely prove optimistic. So we talked a lot about the Middle East. The other thing we tried to factor in here is around the return of Chinese exports, and this is obviously going to be critical to how prices develop later in the year. As I mentioned before, the base case assumes a return from May, but any delay to this view would of course significantly deepen the market deficit, particularly through the Northern Hemisphere's summer, and would limit the ability of the urea market to correct. Thank you very much for your attention today. If you'd like to dive deeper into any of the topics that we've covered, you'll find full detail in our subscription services. Our monthly outlook provides a forward-looking snapshot of market fundamentals, costs, inputs, trade and prices over the short term. And for those wanting to dive a bit deeper, our analytics service offers a long-term view of similar dynamics.